This presentation will discuss tax benefits of Coverdell Education Saving Account ESA. This will be a long presentation, so if you want to jump to relevant points within it, you can take a look at the description, which will have links to those points and descriptions of what those points will contain. In this presentation, we will take a look at an introduction to the Coverdell Education Saving Account, the ESA. This information can be found in Publication 970. Introduction. If your modified adjusted gross income, MAGI, is less than $110,000 or $210,000 if filing joint, you may be able to establish a Coverdell ESA to finance the qualified education expenses of a designated beneficiary. For most taxpayers, the modified adjusted gross income is the adjusted gross income as figured on their federal income tax return. So just to give an example of that, if we take a look at a test 1040, we have a married individual here. The income is going to be the top portion of the return. Modified adjusted gross income is typically line 7, or the adjusted gross income will be line 7. Whenever we see that M before it means modified adjusted gross income, not typically an amount found on the tax return, but it's usually going to be some modification specific to whatever we are talking about. In this case here, we have a modified adjusted gross income, which is in essence the adjusted gross income found on line 7 with any kind of modification specific to the ESA. Back to the text. Total contributions for the beneficiary in any year can't be more than $2,000 no matter how many separate Coverdell ESAs have been established for the beneficiary. See contributions later. So we have that $2,000 limit. Back to the text. Tip. This benefit applies not only to higher education expenses, but also to elementary and secondary education expenses. So when we think about the ESA, we may often think about just the higher education expenses, but remember, also applies to elementary and secondary education expenses. What is the tax benefit of a Coverdell ESA? Contributions to a Coverdell ESA aren't deductible, but amounts deposited in the account grow tax-free until distributed. So when we think about the Coverdell ESA, we often don't really see the tax benefit as we put the money in, and therefore it's something that may not get quite as much of attention. But the point is that we put the money in there as the money grows. If we get something like possibly capital gains, interest, dividends in the savings, then the growth then is what could be tax-free, as opposed to us when we sell something. If we sell stocks or bonds or something like that, we typically have capital gains that we would have to recognize, or the interest and the dividends if we have them in the Coverdell ESA. Then the benefit could be that we don't need to pay the growth and the interest or the dividends or the capital gains, the types of taxes that would be there if we had the money in some other area. And you can think of this as basically two types of accounts. So if you had this account, the Coverdell, and then some other just savings account, you can even have them for the same purpose. It's for education. So the benefit of having something in an ESA or Coverdell ESA isn't just to say, oh, this is for savings for college or something like that. That's nice, but we would do that anyways. We would put the money into a savings account. What you're going to get from something like this is a tax benefit, not that can be seen as easily because you're not going to get the deduction, but you are going to get the increase in the savings you could possibly have being tax-free as the earnings go up. So if one of these if they were in the same kind of investment, stocks and bonds, let's say, they could go up for the same amount. The one that's in the Coverdell would mean that the increase is not taxable. The amount of earnings could be tax-free, as opposed to if we just assigned the dividends or the accounts for stocks and bonds for education, just earmarked it towards education, then we may not get the benefit or won't get the benefit and would typically then have to pay taxes on the increase as it grows over time. Hopefully it will grow. Back to the text. If for a year distributions from an account aren't more than a designated beneficiary's qualified education expenses at an eligible educational institution, the beneficiary won't owe tax on the distribution. So this is going to be the key point, because of course the incentive that's being given by the IRS here is to take this money and then give some type of benefit for the educational purposes. So therefore, the condition is if for a year, distributions from, now the money's going out of the Coverdell ESA. So we're imagining it was put in at some point in time in the past. It has grown over time, and then it's going to be taken out in the form of a distribution. So if for a year, distributions from an account aren't more than designated beneficiaries. So a designated beneficiary, that's who of course we set up the Coverdell ESA for. So if isn't more than designated qualified education expenses, so it has to be, of course, in the definition of what it means to be a qualified education expenses with regard to the regulations for the Coverdell ESA at an eligible educational institution. So another key term, so it needs to be at an eligible educational institution. The beneficiary won't owe tax on the distribution. So we're not going to have the tax at the point in time of the distribution. So that's going to be our goal. So our goal is to put the money in, and we don't get a deduction. We're not lowering the taxes when we put it in. We're not getting the benefit kind of on the front end when we put the money in. However, the money that's coming out should be more than the money we put in, hopefully, if it grew. And we're not paying taxes on the increase. So that's really where the benefit is. So Table 7.1 summarizes the main features of the Coverdell ESA. Coverdell ESA, at a glance. Don't rely on this table alone. It provides only general highlights. See the text for definitions of terms and for more complete explanations. So question, what is a Coverdell ESA? Answer, a savings account that is set up to pay the qualified education expenses of a designated beneficiary. So that's the purpose, that's the goal. We're going to set it up to pay. Now, note, again, the goal, of course, is tax savings. If we were just going to set up a savings account, we could set up a savings account, any kind of savings account, and we could just earmark it as something that we're going to have towards the education. But if we put it into a specific Coverdell ESA, then we have the tax benefit of possibly those earnings then not being taxable at the point in time they're taken out or as they grow. Next item, where can it be established? It can be opened in the United States at any bank or other IRS-approved entity that offers Coverdell ESAs. So obviously when we set one up, we're setting up, in essence, a savings account, some type of investment account. So if you go to a typical area bank or investment, then we can, those are usually where you want to go, and they will likely have information about Coverdell ESAs that we can then look into. Next item, who can have a Coverdell ESA? Any beneficiary who is under age 18 or is a special needs beneficiary. So typically under 18, that's kind of like the objective. Usually we would think of it going to like college education oftentimes. So we're putting money in, we're waiting until it waits so that the person, the recipient, the student, the potential student in the future is going to be, time will pass, and then of course they take the money out for education. That would be the idea usually. And so the qualified would be under 18 and or special needs. Next item, who can contribute to a Coverdell ESA? Generally, and any individual, including beneficiary, whose modified adjusted gross income for the year is less than $110,000 or $220,000 in the case of joint return. So we've got that income limitation, AGI limitation, the 110 and the 220. If you're married filing joint, the higher limitation, single head of household, typically lower limitation. Are distributions tax-free? Yes, if distributions aren't more than the beneficiary's adjusted qualified education expenses for the year. So this is the benefit. At the distributions from the account, do we have to pay taxes on those? And the goal here is no, we don't have to pay taxes on those. That's going to be kind of the point. And that's what we're looking to do, so that we didn't get a benefit on the front end, but as we have the distribution, why would it be taxable in any case? Well, because of the earnings on it, oftentimes would be taxable, and that's what we're not having being taxable here. In this presentation, we will discuss what a Coverdell ESA is. This information can be found in Publication 970. What is a Coverdell ESA? A Coverdell ESA is a trust or custodial account created or organized in the United States only for the purpose of paying the qualified education expenses of the designated beneficiary, defined later, of the account. When the account is established, the designated beneficiary must be under age 18 or a special needs beneficiary. So when considering the Coverdell ESA, the purpose of the Coverdell ESA is the payment of the qualified education expenses. So if we imagine this, we can imagine the designated beneficiary being someone who is typically under the age of 18. We can think of putting the money into a Coverdell ESA and then at some point in the future taking that money out of the Coverdell ESA and using it to pay for the qualified education of the designated beneficiary. Why would we do that? Because of the tax benefits for it, including the tax benefit of not having the gain, of course, hopefully the gain, as we put the money into the Coverdell ESA being taxable if that distribution is for the qualified education expenses. Back to the text. To be treated as a Coverdell ESA, the account must be designated as a Coverdell ESA when it is created. So note, when we think about these types of investments, you might think, well, what is actually this thing, a Coverdell ESA? Well, we're going to be putting money into a type of investment account. And there's nothing really special about that. We could put money into a savings account or some other account, and it wouldn't have to be called, we can name it whatever we want. We could just call it a savings account that we designated for the beneficiary for someone to be going to school. But to make it covered in a Coverdell ESA, we want it specifically designated as such when we put the money in. And the only thing that really does is the investments in and of themselves are kind of like the same type of thing. But if we designate it as a Coverdell ESA and make sure we have that designation, then it's qualified so that the gains on them could possibly have beneficial tax treatment, possibly not being taxed upon distribution. Back to the text. The document creating and governing the account must be in writing and must satisfy the following requirements. 1. The trustee or custodian must be a bank or an entity approved by the IRS. So whoever is controlling the account, the custodian or the trustee of it, must be a bank or an approved entity. Typically, we would think of something like a bank or some type of investments because that's where we would most likely be setting the investments up. But there could be more unusual circumstances, but in essence, has to be approved by the IRS. Number 2, the document must provide that the trustee or custodian can only accept a contribution that meets all of the following conditions. Condition 1, or A, the contribution is in cash. B, the contribution is made before the beneficiary reaches age 18 unless the beneficiary is a special needs beneficiary. And C, the contribution wouldn't result in total contributions for the year, not including rollover contributions, being more than $2,000. So these are going to be the conditions. It's got to be cash. The contribution to it must be cash. The contribution is made before the beneficiary reaches age 18. That's going to be one of our regulations, one of the conditions, unless the beneficiary is a special needs beneficiary. And 3, or C, the contributions wouldn't result in total contributions for the year, not including rollover contributions. That's going to be basically from another plan or something like that got rolled into it, rather than basically new contributions into the plan. So being more than 2,000, so we have that dollar limitation of the 2,000. 3, money in the account can't be invested in life insurance contracts. So it can't be something that's invested in life insurance. Number 4, money in the account can't be contributed with other property except in a common trust fund or common investment fund. And 5, the balance in the account generally must be distributed within 30 days after the earlier of the following events. A, the beneficiary reaches age 30 unless the beneficiary is a special needs beneficiary, and B, the beneficiary's death. So note, as we think about these payments, they're for education typically. So what happens, when do we have to basically give out the beneficiaries or distribute? So we're thinking about when the money went in, we put the money into the account. Now when do we have to distribute it? By 30 days after the earlier of the beneficiary reaches age 30 unless the beneficiary is a special needs or the beneficiary's death. And again, this is the condition when they must be distributed. In this presentation, we will discuss the term of qualified education expenses as they relate to the Coverdell Education Savings Account, the ESA. This information can be found in publication 970. Qualified education expenses. Generally, these are expenses required for the enrollment or attendance of the designated beneficiary at an eligible educational institution. The expenses can be either qualified higher education expenses or qualified elementary and secondary education expenses. So note, as we think about these qualified education expenses, you may hear this terminology with different types of benefits related to education. Want to make sure that you're applying that terminology to the proper area, the proper type of benefit that we are looking at here. So here, the expenses can be either qualified higher education expenses or qualified elementary and secondary education. So it's one component that we want to basically keep in mind, because we may often think of it as being strictly for the higher education, or that being the thought that might be more common. But we also have the qualifications for elementary and secondary, and of course it's for the attendance of the designated beneficiary. So we are once again imagining putting money in, having a designated beneficiary for which that money will be, and then at the end that money being taken and used for the qualified expenses, which include the education expenses. Back to the text, designated beneficiary. This is the individual named in the document creating the trust or custodial account to receive the benefit of the funds in the account. So the designated beneficiary then, for imagining this process, we're putting money into the account for the designated beneficiary, typically being the one that's going to be going to school at a later point in time. The money's being put into the account for that designated beneficiary, and that's going to create a trust or custodial account. And that means that basically this money's going into an account that's going to possibly be under kind of control or management in a trust type format, or custodial, someone's having control over the managing of the account for the benefit, of course, of the beneficiary at the end of the time period, or when it will be distributed from the account. Back to the text. Contributions to Qualified Tuition Program, QTP. A contribution to a QTP, Qualified Tuition Program, is a qualified education expense if the contribution is on behalf of the designated beneficiary of the Coverdell ESA. In the case of a change in beneficiary, this is a qualified expense only if the new beneficiary is a family member of that designated beneficiary. So in other words, we're thinking about two kind of beneficiary programs. We've got the Coverdell ESA and the Qualified Tuition Program. Well, what if there was a distribution from the Qualified Tuition Program, or from the Coverdell ESA to a Qualified Tuition Program, QTP, meaning we've got money going out of the Coverdell ESA to the Qualified Tuition Program? Well, there could be revenue on that money, and of course the goal is for it to not be tax-free. So is it possible then to take the money, is it a qualified distribution, to take the money out of the Coverdell ESA and distribute it to a qualified tuition program, a QTP? And so let's read through it again. A contribution to a QTP is a qualified education expense if the contribution is on behalf of the designated beneficiary of the Coverdell ESA. So if it's on behalf of the designated beneficiary, in the case of a change in beneficiary, this is a qualified expense only if the new beneficiary is a family member of that designated beneficiary. Back to the text, or next item. Eligible educational institution. An eligible educational institution can be either an eligible post-secondary school or an eligible elementary or secondary school. So notice, once again, we're not talking about simply or only post-secondary. We've got the eligible elementary and secondary schools as well. Eligible post-secondary school. An eligible post-secondary school is generally any accredited public, nonprofit, or proprietary, privately owned, profit-making, college, university, vocational school, or other post-secondary educational institution. Also, the institution must be eligible to participate in a student aid program administered by the U.S. Department of Education. Virtually all accredited post-secondary institution meets this definition. The educational institution should be able to tell you if it is an eligible educational institution. So you want to be able to go to the institution, you want to see what their credentials are, who's the accrediting body of them, and if they're accredited, virtually all accredited post-secondary institutions meet this definition, then we should be able to get that information from the institution. Back to the text. An eligible educational institution also includes certain educational institutions located outside the United States that are eligible to participate in a student aid program administered by the U.S. Department of Education. Eligible elementary or secondary school. An eligible elementary or secondary school is any public, private, or religious school that provides elementary or secondary education, kindergarten through grade 12, as determined under state law. Qualified higher education expenses. These are expenses related to enrollment or attendance at an eligible post-secondary school. As shown in the following list, to be qualified, some of the expenses must be required by the school and some must be incurred by students who are enrolled at least half-time. So we have this concept of what does it mean to be qualified education expenses? And so we'll go through the list here. Number 1, the following expenses must be required for enrollment or attendance of a designated beneficiary at an eligible post-secondary school. So they're going to have to be required for enrollment or attendance. These are the expenses we're talking about. A, tuition and fees. So that's going to be obviously the most common one. We would think tuition, well, that would be qualifying. Then we have books, supplies, and equipment. So that would be typical. We would think, okay, the books are kind of pretty much required. And then 2, expenses for special needs services needed by a special needs beneficiary must be incurred in connection with enrollment or attendance at an eligible post-secondary school. Expenses for room and board must be incurred by students who are enrolled at least half-time, defined below. The expense for room and board qualifies only to the extent that it isn't more than the greater of the following 2 amounts. A, the allowance for room and board as determined by the school that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangement of the student. B, the actual amount charged if the student is residing in housing owned or operated by the school. You may need to contact the eligible educational institution for qualified room and board costs. So notice the room and board costs could be includable, but there's some restrictions, and you could see why they might be more concerned, the IRS be more concerned with room and board costs as eligible expenses. So you want to look into those into more depth if that's going to be something of concern or applying to you. Number 4, the purchase of computer and peripheral equipment, computer software or internet access and related services if it is to be used primarily by the beneficiary during any of the years the beneficiary is enrolled at an eligible post-secondary school. This doesn't include expenses for computer software for sports, games, or hobbies unless the software is predominantly educational in nature. So this is something that could be significant. We have other types of equipment and computer software if applicable to the school. Half-time student. A student is enrolled at least half-time if he or she is enrolled for at least half the full-time academic workload for the course of study the student is pursuing as determined under the standards of the school where the student is enrolled. Qualified elementary and secondary education expenses. These are expenses related to enrollment or attendance at an eligible elementary or secondary school. As shown in the following list, to be qualified, some of the expenses must be required to or provided by the school. There are special rules for computer-related expenses. 1. The following expenses must be incurred by a designated beneficiary in connection with enrollment or attendance at an eligible elementary or secondary school. A. We have the tuition and fees. B. Books, supplies, and equipment. C. Academic tutoring. And then D. Special needs services for a special needs beneficiary. 2. The following expenses must be required or provided by an eligible elementary or secondary school in connection with attendance or enrollment. Room and board. We've got the uniforms. We got the transportation. Supplementary items and services including extended day programs. 3. The purchase of computer and peripheral equipment, computer software, fiber optic cables related to computer use or internet access and related services is a qualified elementary and secondary education expense if It is to be used by the beneficiary and the beneficiary's family during any of the years the beneficiary is in elementary or secondary school. This doesn't include expenses for computer software designed for sports, games, or hobbies unless the software is predominantly educational in nature. In this presentation, we will discuss contributions to a Coverdell Education Savings Account, an ESA. This information can be found in Publication 970. Contributions. Any individual, including designated beneficiary, can contribute to a Coverdell ESA if the individual's MAGI, modified adjusted gross income, defined earlier under contribution limits, for the year is less than $110,000. For individuals filing joint return, that amount is $210,000. So in essence, there's an income limitation for the person that is contributing to the Coverdell ESA. $110,000 if we're not married, typically single head of household, $210,000 if married. Back to the text. Organizations such as corporations and trusts can also contribute to Coverdell ESA. There's no requirement that an organization's income be below a certain level. So if we had it is possible then for a corporation or a trust to contribute into the Coverdell ESA, and those income levels do not apply in that case. Back to the text. Contributions must meet all of the following requirements. 1, they must be in cash. 2, they can't be made after the beneficiary reaches age 18 unless the beneficiary is a special needs beneficiary. And 3, they must be made by the due date of the contributor's tax return, not including extensions. So let's go through those again. It has to be cash. They can't be made after the beneficiary reaches age 18. So that's one of the general requirements. The beneficiary, the one that's going to be using the funds, typically the one that's going to be possibly going to school education, can't be 18 at the time of the contribution. And they must be made by the due date of the contributor's tax return, not including extension. So notice it's not saying in the year. It has to be made by the due date of the tax return, not including the extension, which means we may be able to make it in 2019, basically up until April 15th, if we were talking about the tax year of 2018, possibly. Note, it doesn't include the extensions, however. Back to the text. Contributions can be made to one or several Coverdell ESAs for the same designated beneficiary, provided that the total contribution aren't more than the contribution limits defined later for a year. Contributions can be made without penalty to both a Coverdell ESA and QTP in the same year for the same beneficiary. Table 7.2 summarizes many of the features of contributing to a Coverdell ESA. Table 7.2, Coverdell ESA contributions to at a glance. Don't rely on this table alone. It provides only general highlights. See the text for more complete explanations. So here we have our table. The questions: are contributions deductible? Answer: no. You might say, well, what's the tax benefit then? Well, the benefit, unlike if you think of like an IRA, where we put money into a savings account in essence, and you get a deduction, but then it's taxable when you take it out in a traditional. Here we're talking about we're putting money in. We don't get the deduction on the front end, but possibly the interest that accumulates could be not taxed at the time it's then distributed at the end. Back to the text, second item. What is the annual contribution limit per designated beneficiary? Answer: $2,000 for each designated beneficiary. So we got that limit, $2,000 per designated beneficiary. Next item. What if more than one Coverdell ESA has been opened for the same, that's the key term here, same designated beneficiary? So we have two Coverdell accounts, but for the same beneficiary, the same person, the same child probably that's going to be possibly going to school. Answer: the annual contribution limit is $2,000 for each beneficiary, no matter how many Coverdell ESAs are set up for that beneficiary. So in other words, yeah, you can't have two and say, well, there's only a limit of $2,000 per Coverdell. No, it's per beneficiary. So keep that in mind. Next item. What if one or more individual makes contributions for the same designated beneficiary? Answer: the $2,000 contribution limit is $2,000 per beneficiary, no matter how many individuals contribute. So you can see how this, this line of questioning might happen. Well, it's 2,000. Well, what if we have two Coverdell accounts? Well, no, it's still 2,000 per beneficiary. Okay, well, what if we had two different people set up two separate Coverdell accounts for the same student? Could we go over 2,000 then? Well, no, it's for 2,000 per beneficiary. So next item, can contributions other than cash be made to a Coverdell ESA? Generally, no. It says no. So it's got to be a cash contribution. Next item, when must contributions stop? No contributions can be made to a beneficiary's Coverdell ESA after he or she reaches age 18 unless the beneficiary is a special needs beneficiary. So in essence, can't really contribute past that point, past the age of 18. No more money can go in unless there's some kind of special needs beneficiary. Next item, back to the text. When contributions are considered made, contributions made to a Coverdell ESA for the preceding year are considered to have been made on the last day of the preceding year. They must be made by the due date, not including extensions for filing your return for the preceding year. So in other words, we could think about the end of the tax year, and we're trying to think about if we want to contribute. We could contribute money in up until the due date of the return, not including extensions, which is nice because we have a little bit of planning time that we might be able to do at that point. If we make the contribution sometime in the year after, or therefore the contribution was made for the prior year and was made before the tax return was filed, but in the year after, then the contribution would be considered to have been made on the last day of the preceding year. Back to the text. For example, if you make a contribution to a Coverdell ESA in February 2019 and you designate it as a contribution for 2018, you are considered to have made that contribution on December 31st, 2018. In this presentation, we will take a look at contribution limits related to Coverdell Education Savings Accounts, ESA. This information can be found in Publication 970. Contribution limits. There are two yearly limits. One on the total amount that can be contributed to each designated beneficiary in any year, and two, one on the amount that any individual can contribute for any one designated beneficiary for a year. Limit for each designated beneficiary. For 2018, total of all contributions to all Coverdell ESAs set up for the beneficiary of any one designated beneficiary can't be more than 2,000. So let's read through that one more time. For 2018, total for all contributions to all Coverdell ESAs set up for the beneficiary. So for one single beneficiary, all the ESAs of any one designated beneficiary can't be more than 2,000. This includes contributions other than rollovers to all the beneficiaries' Coverdell ESAs from all sources. Rollovers are discussed under rollovers other transfers. So if we're talking about a rollover, we're talking about it going from one account to another, possibly one account that has a tax benefit in some way to another. So that's a different kind of animal, that's a different kind of thing than we're talking about here, which would be the straight contributions. So we would want to go into rollovers if we have a situation where we're rolling some money out of one account to another that may have tax benefits. Let's take a look at an example. When Maria Luna was born in 2017, 3 separate Coverdell ESAs were set up for her, one by her parents, one by her grandfather, and one by her aunt. In 2018, the total of all contributions to Maria's 3 Coverdell ESAs can't be more than 2,000. For example, if her grandfather contributed 2,000 to one of her Coverdell ESAs, no one else could contribute to any of her 3 accounts. Or if her parent contributed 1,000 to her and her aunt contribute 600, her grandfather or someone else could contribute no more than 400. These contributions could be put into any of Maria's Coverdell's ESA accounts. So we can imagine this situation. We've got the 3 accounts here, and the point is that in any one year they have to add up to 2,000. So even if we have 3 different people contribute in here, 3 different accounts, it's all the same beneficiary in essence, and that's what it's coming down to, that we have to put in the maximum per beneficiary, even if it's coming from different people and going into different Coverdell accounts. Limit for each contributor. Generally, you can contribute up to $2,000 for each designated beneficiary for 2018. This is the most you can contribute for the benefit of any one beneficiary for the year, regardless of the number of Coverdell ESAs set up for the beneficiary. Example, the facts are the same in the previous example, except that Maria Luna's older brother, Edgar, also has a Coverdell ESA. If their grandfather contributed $2,000 to Maria's Coverdell ESA, he could also contribute $2,000 to Edgar's Coverdell ESA. So once again, that you can see that the emphasis here on the beneficiary. So if we have two different beneficiaries, then we could typically, the same individual could put in $2,000 to two Coverdell ESAs because they're now two different beneficiaries. Reduced limit. Your contribution limit may be reduced. If your MAGI, which is your modified adjusted gross income, defined later, is between $95,000 and $110,000, between $190,000 and $210,000 if filing a joint return, the $2,000 limit for each designated beneficiary is gradually reduced. If your MAGI is 110 or more, 220 or more if filing jointly, you can't contribute to anyone's Coverdell. So that basically means there's a range here, of course. So there's going to be a limit. So there's 2,000 max, and the lower range is at 95,000 for non-married, like single or head of household, and 190 for married. Now, within the range of 95,000 to 110, then we have the amount that it's going to be reduced by. We'll have to figure out how much we're allowed to contribute in this range as well. And then, of course, when we hit that cap range, the 110 reflected here, and the 220 here, over that we can't contribute anywhere at the end of the range. Back to the text. Modified adjusted gross income, MAGI. For most taxpayers, modified adjusted gross income is adjusted gross income, or AGI, line 7 on the 1040, as figured on their federal income tax return. Modified AGI when using Form 1040. If you file Form 1040, your modified AGI is the AGI on line 7 of that form, modified by adding back any. So these are only things that would apply. So if they don't apply, then of course your modified AGI is your AGI on line 7 of 1040. But if any of these apply, we have to add them back, including number 1, foreign earned income exclusion, number 2, foreign housing exclusion, number 3, foreign housing deduction, number 4, exclusion of income by bona fide residents of American Samoa, and number 5, exclusion of income by bona fide residents of Puerto Rico. In this presentation, we will take a look at additional tax and excess contributions related to Coverdell Education Savings Accounts, or ESA. This information can be found in Publication 970. Additional tax on excess contributions. The beneficiary may owe a 6% excess tax each year on excess contributions that are in a Coverdell ESA at the end of the year. Excess contributions are the total of the following two amounts. 1. Contributions to any designated beneficiary's Coverdell ESA for the year that are more than $2,000, or, if less, the total of each contributor's limit for the year as discussed earlier. 2. Excess contributions for the preceding year reduced by the total of the following two amounts. A. Distributions other than those rolled over as discussed later during the year. B. Contributions limit for the current year minus the amount contributed for the current year. Exceptions. The excess tax doesn't apply if excess contributions made during 2018 and any earnings on them are distributed before the first day of the 6th month of the following tax year, June 1st, 2019, for a calendar year taxpayer. However, you must include the distributed earnings in gross income for the year in which the excess contribution was made. You would receive Form 1099-Q, payments from qualified education programs from each institution from which excess contributions were distributed. Box 2 of that form will show the amount of earnings on your excess contributions code 2 or 3 entered in the blank box below. Boxes 5 and 6 indicates the year in which the earnings are taxable. See instructions for recipient of your Form 1099-Q on the back of Copy B. Enter the amount of earnings on Schedule 1, Form 1040 or Form 1040-NR, line 21 for the applicable tax year. For more information, see taxable distributions later. The excess tax doesn't apply to any rollover contributions. Note, contributions made in 1 year for the preceding tax year are considered to have been made on the last day of the preceding year. See an example of that. In 2017, Greta's parents and grandparents contributed a total of $2,300 in Greta's Coverdell ESA, an excess contribution of $300. So we've talked about the idea that there's a $2,000 limit, $300 over the $2,000. Clearly, here that's our situation. Back to the text. Because Greta didn't withdraw the excess before June 1st, 2018, she had to pay an additional tax of $18, which is 6% of the $300, when she filed her 2017 tax return. So as you look at this, you might try to think about the reasonableness or why this might be applied, because that might help you to memorize or think about this. And obviously, if you think about the benefit of this type of account, it's because the interest or the earnings on it are going to be something that possibly will not be taxable when withdrawn. And so if you put too much in, another $300, you can see that the penalty is at 6% of the $300, which maybe the IRS is saying, hey, that's about possibly what your earnings will be on it. And therefore, that seems like a reasonable way to calculate. That's just my interpretation of, how they might have come up with this concept. Might help to memorize it. Back to the text. In 2018, excess contributions of $500 were made to Greta's account. However, she withdrew $250 from that account to use the qualified education expenses. Using the steps shown earlier, additional tax on excess, Greta figures the excess contribution in her account at the end of 2018 as follows. 1. 500 excess contributions made in 2018 plus 2. 300 excess contributions in ESA at end of 2017 minus 250 distribution during 2018. That gives us the 550 excess at the end of 2018. We multiply that times the 6%, and that gives us the $33. If Greta limits 2019 contributions to $1,450, 2,000 maximum minus 550 excess contributions for 2018, she won't owe any additional tax in 2019 for excess contributions. So you can see this basically a timing difference item happening here. Excess contributions in prior year could lead to differences in the contribution limit, which is typically the 2,000 in the following year, as well as the penalties. Back to the text, figure in the reporting the additional tax. You figure this excess tax on Form 5329 Part V. Report the additional tax on Schedule 4, Form 1040, line 59. In this presentation, we will take a look at rollovers and other transfers related to the Coverdell Education Savings Account, ESA. This information can be found in Publication 970. Rollovers and other transfers. Assets can be rolled over from one Coverdell ESA to another, or the designated beneficiary can be changed. The beneficiary's interest can be transferred to a spouse or former spouse because of divorce. Let's take a look at this again and concentrate on those key terms. Assets can be rolled over from one Coverdell to another. So it's possible to have one Coverdell ESA account and roll them over into another. And the idea of that is we might have two savings accounts. They're both accounts that are having tax benefits. And the rollover then isn't a contribution. So we want to be able to distinguish a rollover from one account to another from a contribution. We might see similar concepts. You might be aware of a similar concept, of course, in like an IRA or a retirement type account where we might want to roll over that information from one tax benefit account to another and not count it, of course, as a contribution. So that would be a common scenario. And then if we go back into, or the designated beneficiary can be changed. Now we might think of situations where that could be the place. We need to change the designated beneficiary. So when can we do that? If we have the ESA account already set up for a designated beneficiary, is it possible to change the beneficiary? So it says here, or the designated beneficiary can be changed. the beneficiary's interest can be transferred to a spouse or former spouse because of divorce. So the beneficiary can be transferred to a spouse or former spouse. Back to the text. Rollovers. Any amount distributed from a Coverdell ESA isn't taxable if it is rolled over to another Coverdell ESA for the benefit of the same beneficiary or a member of the beneficiary's family. So if the rollover happens, it goes from one account to another, typically for the same beneficiary, but it says here as well, or a member of the beneficiary's family, including the beneficiary's spouse, who is under age 30. This age limit doesn't apply if the new beneficiary is a special needs beneficiary. An amount is rolled over if it is paid to another Coverdell ESA within 60 days after the date of the distribution. Don't report qualifying rollovers, those that meet the above criteria, anywhere on Form 1040 or 1040NR. These aren't taxable distributions. So these aren't taxable distributions, and they're not going to be like excess contributions to a ESA account, because they should just simply be a rollover and therefore not have a tax consequence, other than the fact that they're already in the Coverdell account. Back to the text. Members of the beneficiary's family. For these purposes, the beneficiary's family includes the beneficiary's spouse and the following other relatives of the beneficiary. So when we get into that term of what does it mean to be a member of the beneficiary's family, we need to get more specific on that. So here we go. 1, son, daughter, stepchild, foster child, adopted child, or descendant of any of them. 2, brother, sister, stepbrother, or stepsister. 3, father or mother or ancestor of either. 4, stepfather, stepmother. 5, son or daughter of a brother or sister. 6, brother or sister of father or mother. 7, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law. 8, the spouse of any individual that is listed above. 9, first cousin. So we got one, just the first cousin in there. All right, example. When Aaron graduated from college last year, he had $5,000 left in his Coverdell ESA. He wanted to give his money to his younger sister, who was still in high school. In order to avoid paying tax on the distribution of the amount remaining in his account, Aaron contributed the same amount to his sister's Coverdell ESA within 60 days of the distribution. So he got the money. Within 60 days, he distributed it to another Coverdell ESA for a family member. And you can think of situations where this could be the case, right? That the money's already there, $5,000 was left, didn't need it, can't use it at this point in time. If it's distributed without a benefit of education expenses, could result in taxes, and therefore good benefit to contribute it in such a way to the sister, and sister can then get the benefit of it and possibly not have tax consequences. Caution. You can make only one rollover from a Coverdell ESA to another Coverdell ESA in any 12-month period, regardless of the number of Coverdell ESAs you own. So within a 12-month period, one rollover. However, you can make unlimited transfers from one Coverdell ESA trustee directly to another Coverdell ESA trustee, because such transfers aren't considered to be distributions or rollovers. The limit of one rollover during any 12-month period doesn't apply to the rollover of a military death, gratuity, or survivor members group life insurance payment. Changing designated beneficiary. The designated beneficiary can be changed. See members of the beneficiary's family earlier. There aren't any tax consequences if, at the time of the change, the new beneficiary is under age 30, or if the special needs beneficiary is a special needs beneficiary. Example: assume the same situation as Aaron as in the last example. Instead of closing his Coverdell ESA and paying the distribution into his sister's Coverdell ESA, Aaron could have instructed the trustee of his account to simply change the name of the beneficiary on his account to that of his sister. So in essence, in the first example, he got the money and then set up a new Coverdell ESA within the time period allotted to qualify. Here, before getting the money, he thought, say, hey, let's just not take the money out at all, and let's just change the name of the beneficiary. That'll be an easier thing to do, and that could be done as well. Transfer because of divorce. If a spouse or former spouse receives a Coverdell ESA under a divorce or separation instrument, it isn't taxable transfer. Okay, let's do that. It isn't a taxable transfer. After the transfer, the spouse or former spouse treats the Coverdell as his or her own. Example, if their divorce settlement, Peg received her ex-husband's Coverdell ESA. In this process, the account was transferred into her name. Peg now treats the funds in this Coverdell ESA as if she were the original owner. In this presentation, we will take a look at distributions from Coverdell Education Savings Account ESA accounts. This information can be found in Publication 970. Distributions. The designated beneficiary of a Coverdell ESA can take a distribution at any time. Whether the distributions are tax-free depends in part on whether the distributions are equal to or less than the amount of adjusted qualified education expenses defined later the beneficiary has in the same tax year. So let's go through that one more time. The designated beneficiary of a Coverdell ESA, so that's of course who the intended beneficiary was. So we put money into the account and then it's for the designated beneficiary, can take the distribution at any time. So of course they can take it at any time. The question is, when they take it out, is it going to be tax-free at that point in time? That's the point of the thing in the first place. Continuing on, whether the distributions are tax-free depends in part on whether the distributions are equal to or less than the amount of adjusted qualified education expenses, which of course is the purpose of it. So in essence, we would think that if it was for the adjusted qualified education expenses, then we wouldn't have to be including it in income, wouldn't have to be paying tax on it. And if it weren't, then we may have to pay taxes on it. That would be the general thought process. We'll go through the details of the distribution here. Table 7.3, Coverdell ESA distributions at a glance. Don't rely on this table alone. It provides only general highlights. See the text for definitions for terms and for more complete explanations. So we got the question and answer format table here. First question, is a distribution from a Coverdell ESA to pay for designated beneficiaries qualified education expenses tax-free? Answer, generally yes, to the extent the amount of the distribution isn't more than the designated beneficiary's adjusted qualified education expenses. So again, that's going to be the general rule here, of course, that when we take the money out, if it's paid for the beneficiary's expenses, education expenses, and that would be the designated beneficiary's adjusted qualified education expenses, then we should be having what the intention was, which was for them to be tax-free. If not, then we could have tax consequences. Next item. After the designated beneficiary completes his or her education at an eligible educational institution, can amounts remaining in the Coverdell ESA be distributed? So what happens after they're done and there's still money in the ESA? Can it be distributed? Answer, yes. Amounts must be distributed when the designated beneficiary reaches age 30 unless he or she is a special needs beneficiary. Also, certain transfers to members of the beneficiary's family are permitted. Next item, does the designated beneficiary need to be enrolled for a minimum number of courses to claim tax-free distribution? No, doesn't. The item is no. And note again, the distribution has the limit. It could have a limit in terms of the taxable nature of it, up to the beneficiary's adjusted qualified education expenses. So there's that that you have to take into consideration, but there's not that same kind of item we see in some other education benefits of having to take, part-time or full-time student status. Back to the text. Adjusted qualified education expenses. To determine if total distributions for the year are more than the amount of qualified education expenses, reduce total qualified education expenses by any tax-free educational assistance. Tax-free educational assistance includes the tax-free part of scholarship and fellowship grants, veterans educational assistance, the tax-free part of Pell grants, employer-provided educational assistance, any other non-taxable tax-free payments other than gifts or inheritance received as educational assistance. The amount you get by subtracting tax-free educational assistance from your total qualified education expenses is your adjusted qualified education expenses. Tax-free distributions. Generally, distributions are tax-free if they aren't more than the beneficiary's adjusted qualified education expenses for the year. Don't report tax-free distributions, including qualified rollovers, on your tax return. So if you get a distribution, the question again would be, well, do we have to include it in taxes? That would be money to us in that sense, taken out to us. Well, if it's for the qualified education expenses, then we're not going to include it in income and therefore not put it on the 1040. That's going to be the benefit for it. Back to the text, taxable distributions. A portion of the distribution is generally taxable to the beneficiary if the total distributions are more than the beneficiary's adjusted qualified education expenses for the year. Excess distributions. This is the part of the total distribution that is more than the beneficiary's adjusted qualified education expenses for the year. Earnings and bases. You will receive a Form 1099-Q for each of the Coverdell ESAs from which money was distributed in 2018. The amount of your gross distribution will be shown in Box 1. For 2018, instead of dividing the gross distribution between your earnings, Box 2, and basis amount already taxed, Box 3, the payer or trustee may report the fair market value account balance of the Coverdell ESA as of December 31st, 2018. This will be shown in the blank box below boxes 5 and 6. The amount contributed from the Coverdell benefits, see military death gratuity earlier, is treated as part of the basis and won't be taxed by distributed. Figuring the taxable portion of the distribution. Figuring the taxable portion of a distribution. The taxable portion is the amount of the excess distribution that represents earnings that have accumulated tax-free in the account. Figure the taxable portion for 2018 as shown in the following steps. So if we think about this in terms of just imagining what it should be to have the taxes that would be included, remember the benefit. We put the money in, so we've already put in the investment. The goal of it is for it to accumulate upwards. As it accumulate upward, then when we take out both the original investment and we take out the increase in value, the gain, and that's the part that's going to be tax-free. Well, what if there's going to be some portion that's going to be taxable as we take it out? It doesn't make sense then for us to have to pay taxes on the original contribution. We shouldn't have to be taxed on the original contribution. In the event that we're taxed on anything as we take it out, then it should be taxed just basically on the interest, some portion of the interest portion. So keep that in mind as we go through here. Step 1, or number 1, multiply the total amount distributed by a fraction. The numerator, top portion, is the basis contributions not previously distributed at the end of 2017, plus total contributions for 2018, and the denominator, bottom part, is the value balance of the account at the end of 2018 plus the amount distributed during 2018. 2. Subtract the amount figured in 1 from the total amount distributed during 2018. The result is the amount of earnings included in distributions. 3. Multiply the amount of earnings figured in 2 by a fraction. The number, top part, is the adjusted qualified education expenses paid during 2018. Denominator, bottom part, is the total amount distributed during 2018. 4. Subtract the amount figured in 3 from amount figured in 2. The result is the amount the beneficiary must include in income. The taxable amount must be reported on Schedule 1, Form 1040, or Form 1040 NR line 21. So let's take a look at an example. You receive an 850 distribution from your Coverdell ESA, to which 1,500 had been contributed before 2018. There were no contributions in 2018. This is your first contribution. This is your first distribution from the account. So now we're taking the money back out here. So your basis in the account on December 31st, 2017 was 1,500. The value balance of your account on December 31st, 2018 was 950. You have 700 of adjusted qualified education expenses, what they're going to call AQEE, for the year. Using the steps in figuring the taxable portion of distribution earlier, figure the taxable portion of your distribution as follows. So we're going to have the 850 was the distribution. Then we're going to take the 1,500 basis plus 0, the contributions, divided by 150 value plus the 850 distribution. So this is going to be our formula. That'll give us the 107 basis portion of distribution. Step 2, we're going to take the 850 distributions minus the 708 basis portion of the distribution. That gives us the 142 earnings included in the distribution. So this is the amount of earnings. And again, that's the part that is the iffy part. Should we have to include the earnings or not? That's what we need to, because the basis portion is the portion we're going to say, hey, that's just the return of the basis. We shouldn't have to pay taxes on that information. Then we take that and go to part 3. We're going to take the earnings times 700, which was the QEE earlier, divided by the 850 of distributions, and that's going to give us the 117. That's going to be the tax-free earnings. So if we take the 142 of the earnings minus the tax-free portion, the 117, that gives us the 25, which is the taxable portion of the earnings that we would need to include. You must include 25 in income as distributed earnings, not used for qualified education expenses. Report this amount on Schedule 1, Form 1040, line 21, listing the type and amount of income on the dotted line. Worksheet 7.3 at the end of this chapter can help you figure your adjusted qualified education expenses, how much or of your distribution must be included in income, and the remaining bases in your Coverdell ESAs. In this presentation, we will take a look at coordination with the American Opportunity and Lifetime Learning Credits with regard to the Coverdell Education Savings Account ESA accounts. This information can be found in Publication 970. Coordination with the American Opportunity and Lifetime Learning Credits. So we might have the question here then, what are we going to do when we have this Coverdell ESA, which is going towards education, and then we've got these credits, which is the American Opportunity Credit and the Lifetime Learning Credit. How do those things mix together once the student is then going to school? Let's take a look. Back to the text. The American Opportunity or Lifetime Learning Credit can be claimed as the same year the beneficiary takes the tax-free distribution from a Coverdell ESA as long as the same expenses aren't used for both benefits. So we can have both then, but we can't use the same expenses for both benefits. Continuing on, this means the beneficiary must reduce qualified higher education expenses by tax-free educational assistance and then further reduce them by the expenses taken into account in determining an American Opportunity or Lifetime Learning Credit. Let's take a look at an example. Derek Green had $5,800 of qualified education expenses for 2018, his first year in college. He paid his college expenses from the following sources. He had partial tuition scholarship. This is going to be tax-free money of $1,500. He had the Coverdell ESA distribution. So these are the funding that this is the money he got to pay for the $5,800 higher education. So part of it's from the Coverdell. He's got the gift from the parents. So the parents gifted $2,100 to pay. And then we've got earnings from a part-time job of $1,200. That gives us the total. In other words, obviously the 1,500 plus the 1,000 plus the 2,1 plus the 1,200, whoop, too many zeros, gives us that 5,800 of the total expenses that we used for college. So back to the text. Of his 5,800 of qualified education expenses, 4,000 was tuition and related expenses that also qualified for the American Opportunity Credit. So 4,000 was used for the American Opportunity Credit. So remember that what is basically the biggest credits you can usually get. It's bigger than the Lifetime Learning Credit, in other words. So typically 4,000 is what you can max out and consume for it. So we're going to say, all right, well, 4,000 was for tuition related expenses that also qualify for that. That's going to be the 4,000. Derek's parents claimed 2,500 American Opportunity Credit. based on the $4,000 expenses on their tax return. So that $4,000 results in a $2,500 credit, which is the maximum amount of credit for the American Opportunity Credit. Before Derek can determine the taxable portion of his Coverdell ESA distribution, he must reduce his total qualified higher education expenses. So we're going to take the total qualified higher education expenses, $5,800. We're going to subtract out tax-free educational expenses, and that's going to be the $1,500. So things like the scholarship are going to have to be removed. So we'll remove that, minus expenses taken into account in figuring the American Opportunity Credit. So we can't include that $4,000 because that would be doubling up on the benefits. So we're taking out that $4,000. That leaves us with adjusted qualified higher education, or AQHEE, of $300. Since the adjusted qualified higher education expenses, $300, are less than the Coverdell ESA distributions of $1,000, part of the distribution will be taxable. So notice how these two interplay. The $4,000 that was used up in the credit calculation, the American Opportunity Credit, made it so it could not go towards the qualified higher education, the adjusted qualified higher education, resulting in us taking too much out of the Coverdell ESA and having part of it be taxable. The balance in Derek's account was $1,800 on December 31st, 2018. Prior to 2018, $2,100 had been contributed to his account. Contributions for 2018 total $400. Using the fourth step outlined earlier, Derek figures the taxable portion of his distribution as follows below. So we've got the 1,000 distribution times the 2,100 basis plus the 400 contributions over the 1,800 value plus the 1,000 distributions. That gives us the 893. That's the basis portion. So then we have to take the total 1,000 minus the basis portion to get that 107 earnings portion. So that's going to be what was allocated to the earnings. Then the 107 earnings portion times the 300, which was that excess amount over the 1,000 distribution, the total distribution, that gives us 32. That's going to be the tax-free earnings. And then we have to take that 107 total earnings minus the tax-free earnings to get the 75 taxable earnings. So Derek must include $75 in income. Schedule 1, Form 1040, line 21. This is the amount of distributed earnings not used for adjusted qualified education expenses. In this presentation, we will take a look at coordination with qualified tuition programs, QTP, distributions with regard to the Coverdell Education's Saving Accounts, ESA. This information can be found in Publication 970. Coordination with qualified tuition program, QTP, distributions. If a designated beneficiary receives distributions from both a Coverdell ESA and a QTP in the same year, and the total distribution is more than the beneficiary's adjusted qualified education expenses, those expenses must be allocated between the distribution from the Coverdell ESA and the distribution from the QTP before figuring how much each distribution is taxable. The following two examples illustrate the possible allocations. So once again, we got this item here, or the situation in which we have two different types of benefits for education benefits. And now what's going to happen if we have distributions from both the Coverdell ESA and the QTP in the same year, and we have more expenses. If we had more qualifying expenses than were distributed, then you would think that we would be okay in that situation. But if we're in a situation where the qualified higher education expenses are below the distributions of both the Coverdell ESA and the QTP, then we could have some taxable income, and we're going to have to say, well, how are we going to do this allocation between the two of them? Example 1. In 2018, Beatrice graduated from high school and began her first semester of college. That year, she had $1,000 of qualified elementary and secondary education expenses, QESEE, for high school, and $3,000 of qualified education expenses, QHEE, for college. Her QESEE doesn't include tuition. To pay these expenses, Beatrice withdrew $800 from her Coverdell ESA and $4,200 from her QTP. No one claimed Beatrice as a dependent, nor was she eligible for an education credit. She didn't receive any tax-free educational assistance in 2018. Beatrice must allocate her total qualified education expenses between the two distributions. 1. Beatrice knows that tax-free treatment will be available if she applies her $800 Coverdell ESA distribution towards her $1,000 of qualified education expenses for high school. The qualified expenses are greater than the distribution, making the $800 Coverdell ESA distribution tax-free. So note that the Coverdell ESA could go to high school. So that's going to be a nice benefit there. It's not just for the college education. 2. Next, Beatrice matches her $4,200 QTP distribution to her $3,000 of QHEE and finds she has an excess QTP distribution of $1,200, which is the $4,200 QTP minus $3,000 of the QHEE. She can't use the extra $200 of high school expenses because it doesn't qualify. It qualifies for the QTP. It qualifies for the Coverdell ESA, but possibly not for the QTP. So the excess of the $200 of high school expenses, no use to her at this point. From one above, against the QTP distribution, because those expenses are not high school tuition expenses and don't qualify for a QTP for tax-free treatment. 3. Finally, Beatrice figures the taxable and non-taxable portion of her QTP distribution based on her $3,000 of QHEE, and we could see figuring the taxable portion of distributions in Chapter 8 for more information on that. So that'll give us some idea of the play between the benefits of these two educational benefits.